Let me make sure I'm understanding this. Is it the companies that have the highest wages, average wages that do well, or the companies that rely a lot on low-wage workers but are raising those wages the fastest that do better than low-wage dependent companies that aren't?
What we're seeing is that wages are rising more quickly in the lower ranges. So basically, if you are a lower wage worker, there's a good chance that the wages in the job you're working on are rising faster than if you're a high wage worker. And so I think what we're seeing, with businesses and with the equities around them is that if you have more lower wage workers in your employment, you're feeling a little bit under more pressure, whether you have raised wages yet or not. That's where the pressure is coming. Either you haven't been able to hire enough employees, that maybe is hurting your growth story, or you have raised wages, you are able to find people, and you're growing fine, but maybe it's hurting your margins a little bit.
So on what basis, what did you do to come to the conclusion you came to, which is the higher the wages, basically, the better the stock performance? What was the data sort? What does the data sort look like?
Yeah, so our group handles Barclays' work with alternative data and machine learning and other advanced empirical methods. And for this one, we used a data source called Rebellio. They create profiles of companies that basically have the full distribution of wages, who makes, how many people make lower wages, how many people make higher wages. And from that, we were able to come up with a measure of how dependent companies were on lower wage workers. And then we saw that, at least over the last 4 months, there's been a good stock correlation, or a good correlation rather, between stock market performance and just what percentage of your workers earn below median wage.
So let's bring it down out of the theoretical and into the real world. This means buy what and sell what? Give me some examples.
Sure. We offered a few examples. So, we think that selling sort of more traditional types of restaurants. So an example that we had in our report was Cracker Barrel, where, basically they pay people towards the lower end of the range, and then buying some of the food service companies that pay people more. Starbucks is the one that we had as an example there. And you see that they take a lot of pride in terms of both how they pay people and also the benefits that they offer. And so our expectation is, as wages go up, they're going to be a little less squeezed than these other companies that have traditionally paid a little bit lower wages.